Good morning, ladies and gentlemen. I'm joined by Andy Rachleff, the founder of Wealthfront, the automated financial advisor, now up to 11 billion in AUM. Andy, I think a great place to start would be your origin story. So you founded a VC firm in 1994, retired, and then came back into the business in a sort of Michael Corleone fashion. You were pulled back in, right? Now, why are you here sitting with me talking about the future of wealth management and not sipping a Mai Tai somewhere in Hawaii?
Because I'm not very bright. So when I retired from Benchmark, I wanted to give back because I had been afforded a life that I had never imagined. And so I decided to teach at my grad school alma mater, to go on the board of trustees of my undergrad alma mater. My wife and I started an innovative cancer research funding initiative. And the idea for Wealthfront came from my involvement on the Penn Board of Trustees on their Endowment Investment Committee. The premier university endowments are the best managed pools of capital in the world. And one day the investment team gave a presentation on how they generate their great returns. And it struck me that with some changes and availabilities of application programming interfaces, you could automate in software what they were doing manually and do an 80-20 on what they do. And that was important because many of the people that I'd recruited to my portfolio companies when I was a venture capitalist went on to financial success and then would come to me for investment advice. And I could never tell them to do what I do because I was in the incredibly fortunate position to have access to the best investment products and services and the high minimums. And I couldn't tell them, even with 1 to 5 million, I couldn't tell them what to do. And that always struck me as wrong. So I thought, well, if I did this, that would be yet another social good. And if I had known how hard it was going to be, I never would have done it.
And so you guys have really sort of stood out in as much as you are, the poster child in a sense for, anti-human advisors, in as much as you don't really need them for the audience or the clientele, rather, that you're going after, which is sub 40 years old, thereabouts. The question hanging over the space, I think, is, well, what about when they get older and they make more money and they have more complex sort of financial needs and desires? Will that change?
Well, that's the million-dollar bet. My investment idol is a guy named Howard Marks, who founded a firm called Oaktree Capital, which is the leading distressed debt investor. And Howard's as well known for his quarterly letter to his investors as he is his great returns. And I actually just spoke to him this morning. And every one of his letters is based on the exact same framework, which is investing can be described, and I believe entrepreneurship can be described with a 2x2 matrix. You're either right or wrong, and you're either consensus or non-consensus. Now, obviously, if you're wrong, you don't make money, but if you're right in consensus, you don't make money or outsized returns. The way you make outsized returns as an investor and entrepreneur is to be right in non-consensus. Now, when you start, all you know is that you're non-consensus. You don't know if you're right. But if you are proven to be right, that's where the great returns come from, and that's where we, as Benchmark Capital, would try to focus. That if we thought something was too consensus, we didn't want to do it because it didn't have the upside. So the million-dollar question for us is, can we evolve our software to meet the needs of our clients as they age and grow wealthier? Now, if you think back to 6 years ago when we started with a very rudimentary asset allocation service. Today, we offer the most comprehensive and tax-efficient passive investment platform. We offer a completely automated suite of financial planning capabilities, and we offer the first of our banking services, the ability to borrow against your portfolio. Radical difference between now and then. So what do you think we're going to have in 6 years' time? Think about it. Amazon started as an online bookstore. And if you read the articles at the time, Barnes & Noble was going to crush them. Well, Amazon certainly software keeps getting better over time, and that's the bet that we're making, is that we can continue to enhance what we do and deliver more and more value.
But do you think as robo-advisors sort of enhance their offerings, make them more complex, as you just described, is there a chance that they then lose those first-time folks who, you know, when they came to rise out of the recession, right? Are you going to lose those first-time folks who maybe would have been interested in Wealthfront in, you know, 2012?
So now you're asking me a question from my product market fit class at Stanford. So there's a brilliant book on this topic called Crossing the Chasm that was to the 1990s entrepreneurship what the lean startup is to entrepreneurship today. And in that book, Jeffrey Moore postulated that every technology product is adopted at a particular rate. There's a technology adoption life cycle. And no matter how great the product is, it doesn't immediately take over the market, because first you have to go to early adopters, and then you have to go to pragmatists who only buy on references, and then you go to the conservatives who only buy once something becomes a standard. And what you find with almost every company is that in order to serve the pragmatists, you have to do things different than what you serve for the early adopters. And that's a typical progression for.
So what's going to happen to them?
It's like Facebook users.
Yeah.
The early Facebook users have moved on to Instagram. This is a natural course. Now, you said as we make our software more complex. I just want to take issue with that, because our vision is to deliver a service where you direct deposit your paycheck with us, we automatically pay your bills, we automatically top off your emergency fund, and then route money to whatever account is the most ideal for your particular goals, whether they're at Wealthfront or elsewhere. Now, it's going to take us a few years before we do that, and the beauty of that is you will never have to worry about your finances. You can focus on what matters to you, because I don't think you wake up thinking about, God, I really want to work on my finances today.
No, just moderating panels.
Exactly. So if we can do that, and we can do it in a way that is completely effortless and convenient, then why wouldn't someone?
So what is the target demographic you think that would be targeting?
People who grew up digitally native. So our clients, 85% of them are under 45. No one has that profile. And they literally say, we pay you not to talk to us. That's heresy to the incumbents who say, hey, when they get older, they're going to come to realize the errors of their ways.
Well, that's right. Schwab says that 75% of their millennial users tell them that they want a human advisor to talk to.
And they have almost no millennial users. So their average age of a Schwab client is 58 years old. And they've got 25 billion under management, far more than we do, but only 2 billion of that 25 billion came from new clients.
Okay, so you don't view Schwab as they're not your bane, right? So who is then? When you look at the landscape, right, there's talks about Amazon making moves into financial services. They could potentially white label a sort of robo product and then disseminate it out to all the folks, millions of folks using their e-commerce site. You have folks like Morgan Stanley rolling out digital products for their children of their wealthy clients. Who do you aspire to be like, and what do you aspire to not be like, in a sense?
Okay, well, we aspire to be most like Vanguard. So we have gotten to know the folks at Vanguard really well because we use a lot of their products. They're phenomenal. And the thing that we love about Vanguard is they're the only financial service company we know that always puts the client's interests first. If you meet with them, every meeting starts off with, how does this benefit our clients? Now, they have the benefit of a not-for-profit business model. And so they can price their services at really low levels. Our challenge is to use technology to bring the cost down so that we can do the equivalent of what Vanguard does.
But you're not profitable right now.
Correct.
How do you get to that point? Is it selling investors a future promise? Is it going public? What's sort of the plan for the
Well, the beauty of our completely automated approach is that it has incredible operating leverage. So if you think about it, we have a high fixed cost. That's the engineers. No one has as many engineers. 60% of our employees or engineers. That's really unusual in fintech. Most fintech companies are heavy on the fin, low on the tech.
Is that right?
We're low on the fin, high on the tech. And so we have a 90% gross margin. We don't spend money on advertising, which everybody else does. So all of the revenue goes to the bottom line. So the rate at which we are reducing our burn rate is growing.
Mm-hmm. Well, that's an interesting point that you make about marketing, because I think there is a lot of hype in this space, and firms, going out to the public and saying, we are saving the middle class. When you look at the space, do you see a lot of marketing, or do you see a lot of technology being built and designed that's actually helping folks who have never been served by Wall Street before?
I see a lot of marketing. There's a tremendous amount of money spent on advertising, which doesn't make any sense to me. Think about our business. We charge 0.25% as our advisory fee, a flat 25 basis points. And the average fee charged by a traditional financial advisor is 102 basis points, or 1%. So they charge 4 times what we do. If they have access to the same websites that we do to advertise, how can we make up a 4-to-1 disadvantage? And that's why we spend all of our efforts on building products that can delight, because delight is the greatest form of virality.
Mm-hmm. But do you think, you did...
But no one seems to be doing that. If you look at the marketing budgets of most fintech companies, they're really, really high.
Do you think that might put you at a disadvantage in terms of communicating with, the universe of potential clients and the existing clients when you guys rolled out?
Well, we're the fastest growing, so it seems to be working out okay.
Well, when you rolled out, risk parity, for example, there was, some backlash with the pricing. Was that a communications thing? What do you think was behind that? And, obviously there's always something that happens with any company. How do you navigate that?
We aspire to always deliver new services at the lowest price in the market. And we anchored our pricing on the alternatives in risk parity, so it was the lowest cost risk parity, not necessarily the lowest cost ETF. We've addressed that. And look, we're going to keep on delivering new services that we automate. Fortunately, the vast majority of our clients love it. A few pundits didn't like it, but the vast majority of our clients love it. We now have over $1 billion invested in risk parity, and people are benefiting greatly from that enhancement to their portfolios.
Why do you think there was so much surprise around not only that product, but generally across the market, a perception that the OG robos, in a sense, are sort of moving slightly away from that original simple thesis of passive investing?
Well, it actually is passive, but I don't want to get into that. It's no more active than modern portfolio theory at allocating a portfolio. It's a different way to allocate a diversified portfolio. But that's not this is a religious argument. What constitutes passive? And we can argue that till the cows come home.
Well, I think the cows are still home, so if you want, you can...
I think we believe that what we try to do is computers are much better at implementing rules than people are. And if you look at academically proven, time-tested investment strategies to enhance your outcome, they're all rules-based. And so all we've done since we started is continue to deliver new services that are rules-based. So we started with rebalancing. First, index funds are rules-based, then rebalancing. Then we were the first to deliver tax loss harvesting. Then we did stock level tax loss harvesting. Then we did smart beta. And risk parity was yet another rules-based system. And we take that approach to financial planning as well. We use data, first-party data from your financial accounts and third-party data to try to help you figure out things like, well, in a couple of weeks, we're going to introduce the ability to explore whether or not you can afford to take time off. For our customer base, wondering whether or not you can take 6 or 12 months off is a far greater priority than saving for retirement. But no financial planner would build that kind of capability.
Why not?
Because their clientele is typically in their 50s and 60s, and that's not what they're worrying about. So we build our automated financial planning around the needs of our target audience which are people who are in their 20s and 30s. So that means, can you afford to take time off for college? Or can you afford to pay for college? Can you afford to buy a house? Can you afford to buy a house in the particular neighborhood that you want? What kind of house can you buy in that neighborhood? That doesn't come with traditional financial planning.
And how do you balance, right, offering all these services that could make potentially your clients' lives easier and keeping the product simple?
Well, that's design. And design is not something that you find in finance firms. So we were amazed that when we went to Vanguard, they didn't have any designers. And their product looks it. I mean, they build great investment products, so best index funds on earth. But if you look at a service that combines all of those things, it looks like 1997.
You, when we were backstage, you were telling me about how you didn't necessarily teach entrepreneurship at Stanford, but something related to entrepreneurship. What was it you would tell your students to understand what it takes to be a great entrepreneur?
Well, I often get asked, how can you teach someone to be an entrepreneur? And I say, I don't. What I try to do is teach people what are the issues that they're going to face in an entrepreneurial company, in an early stage company. So I focus on technology startups. I've taught 5 different classes now at Stanford GSB.
So what are those things?
So what are some of those issues?
Yeah.
Well, the course about which I'm most passionate is one that I created about 10 years ago on the subject of product market fit. That's a term I actually coined. And it was something that was really important to me as a venture capitalist, because what I found was that companies do not fail due to poor execution, which is the commonly held perception. They almost always fail because the dogs don't want to eat the dog food. And almost every company that succeeds follows the same pattern, whether or not they try to. Most do it by accident. They find product market fit following a particular process. And so what my teaching partner and I do, we've basically codified that process and tried to teach people some of the issues that come with that.
And a key part for Wealthfront has been skating to where the puck is going and not where it necessarily is.
Well, that's a big part of it. You know, most analysts focus on magnitude, not rate of change. So they say to us, well, if you were so great, you would have 100 billion under management. Again, back to the point I made earlier, there's a natural rate at which new things can be adopted. And so as a venture capitalist, I was taught to look for the companies that were undergoing an increase in growth rate, because that meant there was heat. The magnitude was irrelevant. You looked at rates of change. And that's why if you look at our business, we are the fastest growing player in our space, even though we spend a tiny fraction of what everybody else does on marketing. Now, if you're going to focus on magnitude, you'll say, Charles Schwab, oh, they've killed you. Well, this is a marathon, and I bet on rate of change.
So they have this thing at the end where I basically ask you a few topics, and you tell me if they're underrated or overrated. So the first one, very near and dear to me, is cryptocurrency. Overrated, underrated?
Overrated.
Overrated. Betterment.
As an investment.
Betterment.
I'm a gentleman.
Human financial advisors.
Overrated.
Avocado toast.
Overrated.
I don't think
I'm 59 years old, so I don't fit.
Us 22-year-olds love our
I know you do.
fintech regulation. I mean, this is a hot button issue.
Underrated.
You mentioned data before.
Underrated.
What issues do you think there are in terms of on the regulatory side? Third-party data sharing has been a hot.
So I think that's an enormous one.
Has that impacted Wealthfront?
Not yet, but the banks are looking for any excuse not to make their data available. And the availability of that data makes it possible for us to deliver planning experiences and completely automated finances like nothing we've ever seen before. But the banks really don't want that data come out, especially the fees in that data. So what they've now said is, well, we'll make the data available via OAuth, but we won't include the fees in that data. Well, why? Clearly, they want to keep charging outrageous fees. So if we don't live up to some of these laws that I think are in the best interest of consumers, that will be really bad for consumers.
Well, put the banks on notice, I suppose. Thanks so much for listening. I'm happy to introduce the next interviewer, Jill Schlesinger of CBS News. I spent a lot of time backstage practicing that name. I hope I got it right. Thank you so much.
Thank you.